That's part of the reframing. I don't want to obsess about benchmarks with you as much as I do, but that's what I do. So 2013, let's look forward now. It's important to understand there is now some signal in the global economy that we have come through our mid-cycle crisis and that global growth is starting to accelerate. But please recognize where global growth comes from. So in this slide, I've delineated the contribution of emerging markets to global growth. That's the green. And the contribution of the developed markets, the U.S., et cetera, that's the blue. And you can see there's definitely been a power shift in terms of where economic growth comes from. And so you can see the acceleration, but 70 to 80%, if not more, of global growth is really coming from these emerging markets. However, there are reasons to be somewhat optimistic about the U.S. economy now. This is a slide that simply states that after a major financial crisis, the first half of a recovery phase tends to be slower economic growth than the second half of the recovery phase. And there's evidence of that going back to the European nations in the 80s and 90s and also in Asia after the Asian financial crisis. And I think we're primed to do that here in the U.S. as well, and I'll show you why. Number one, housing is no longer a drag. It's actually a tailwind for us, right? If you saw any of the headlines recently, the year-end numbers have now settled. I think new home sales were up 28% last year. Home prices are up 7% year over year. Housing starts have started to really climb. In fact, there was a home builder sentiment survey recently that was higher than it was in 2006. And so there really is some momentum in the housing industry, and that percolates out into Home Depot sales and jobs and all sorts of things. So we do have a contributor now in the housing industry. Also, this is pretty amazing. The U.S. energy complex is really going through an absolute renaissance. This is a chart going back to 1860 that shows the annual change in U.S. oil production. And you can see, thanks to new technology, that not only goes down, it goes across. I mean, it basically does anything needed to get oil out of the ground, that we've actually gone to historic incremental gains. Am I doing that? Okay, I'll stop moving. Historic incremental gains. And so there's a real renaissance going on in the energy complex. That is a tailwind. Finally, manufacturing is starting to add value. And here's why. As poorer nations get richer from having cheap manufacturing activity, wages rise. And in the U.S., we're very productive, but our wage levels are high. The Fed has printed a lot of money, which has taken the dollar down. Essentially, U.S. manufacturing is getting more price competitive with manufacturing in many of our other competing nations. And so the U.S. is gaining competitiveness here, and that's adding to economic growth and employment gains. So let's look at the employment gains by industry, because I think this will surprise you. I'm just indexing everything to 100, going back to September of 2008. So the government's been shedding jobs, right? That's something they have to do because their balance sheet's out of whack. In terms of the finance industry, we lost jobs in the finance industry, but it wasn't quite as dramatic as you might have expected. It's slowly recovered in terms of some job creation, but the big banks are not really hiring right now. They don't know what the settlement fees are going to be on the mortgage mess, and J.P. Morgan laid off 4,000 people the other day. So we're not really getting a whole lot from the finance industry. This is really interesting. The information, the tech industry, which has been doing probably arguably the best of any of the industries in this recovery, has actually been shedding jobs all along the way. So the irony of that in my head is that the most innovative sector of the economy figures out a way to innovate away their own labor force. The construction industry, which obviously took the brunt of the damage in the financial crisis, has started to come back. I imagine that'll continue. Here's manufacturing. So after not adding any jobs since like the 70s, we're actually seeing gains in manufacturing employment. Now, this is the one that I hope will kind of blow your mind. That is in the energy patch. So the mining and logging industries, which contain also energy production, has been adding dramatically to the employment roles. And so politically, you may not like the way this looks, but economically, this is a big deal. And so we haven't regained all the jobs we lost. We lost 9 million in the Great Recession. 5.5 million of those have come back. But I think that'll continue, and I think the pace of hiring will actually pick up. That being the case, the underlying support for U.S. GDP growth, I think, is pretty good, okay? So what are the risks to this forecast? Well, the old risk that we all want to talk about is Europe. This is a chart that I think is pretty interesting. It goes back to mid-90s, before the adoption of the euro. Before the adoption of the euro, if you were interested in buying a European sovereign government debenture, you actually did a little research on that individual country. So you can see that they traded independent of each other. And then when you got into the adoption of the euro, the credit markets just figured out, well, I guess it's just Germany's balance sheet we have to worry about now. And so everybody converged. Then after the financial crisis, everybody went, wait a sec, maybe we should start looking at these countries individually now. So the bad news is we're looking at all these countries individually now. The good news is we're just doing business the way we used to do it, okay? So I think the crisis in the Eurozone is somewhat off the table for now. That doesn't mean they don't have a growth crisis, doesn't mean they don't have a jobs crisis, doesn't mean they don't have a regulatory crisis, but I think the imminent financial crisis is off the table. All right, there's a new risk on the table. You may have heard about this in the news. It sounds very, very scary. It's the currency war concept. Now, why do we have a currency war? Nations around the globe are competing for growth, and they've got bloated deficits, they've got high unemployment rates, and so how do you get growth? Well, one of the ways to do it is to devalue your currency. If you devalue your currency, you effectively put all the goods and services of your nation on sale. It's a fire sale. And so to win in a currency war, or growth war, if you want to call it that, you need a central bank that has a lot of conviction and is willing to print a lot of money. So in the lead right now, we have the Bank of Japan. The Bank of Japan has increased the size of its balance sheet, just think about that as money printing, by about 9% since the middle of June. They're in first place. In second place, the Stars and Bars, proud of that. So the American Federal Reserve has increased the size of its balance sheet by about 5% since June. In third place, those stodgy Europeans who really don't like inflation have actually been shrinking their balance sheet since June. So that's the reason why you're seeing strength in the euro currency, weakness in the yen, and relative weakness in the dollar. 2 words on that. One, what do you do about this as investors? One, you want to make sure that you're exposed to multiple currencies. So in all of the work that we do at W&A, anything that we invest in internationally, the currency is unhedged, because I think it's important in this global economy to have diversification across currency exposure. 2, look for the cues. Obviously, the reaction to this from a policy perspective is to increase tariffs, subsidies, capital controls. All of those retard economic growth. They're not good news, but I don't think there's any imminent threat. Currency wars play out over a long period of time. All right, the bigger risk, and by the way, I was the only person saying this a month ago. Now it's become consensus, I feel like, and Jay and I have talked about that. But inflation requires 2 things. It requires a supply of money, right? But it also requires that money to circulate, right? So for those of you who remember the equation, MV equals PQ, it's the amount of money times the speed by which it circulates. And so this is a chart of monetary velocity. We all know that we've got record supplies of money, right? But we also have record low velocity, and so that money's not really going anywhere. Well, what would happen if velocity turned around? Well, that to me is kind of a threat, because the U.S. Federal Reserve has told us they're not going to do anything until the unemployment rate gets down below 6.5%, which by my math means the middle of 2015 or something of that nature. If, however, velocity turns around, if we all get excited, want to build businesses, want to sell businesses, want to do M&A, want to borrow money, and the velocity of money starts to increase, well, that can lead to a spike in inflation, could lead to an upward spike in interest rates, and it could call the Fed to action. And that would spook the markets. We've seen examples of that in the past. And in fact, if you've been watching the market over the last 2 weeks, there was a Fed minute that came out that talked a little bit about maybe taking away the punch bowl. The markets went down. Bernanke was on the Hill for the last couple days doing his Humphrey Hawkins testimony. He reassured everybody that the fire hose is open and we got plenty of water. So markets are back up. Tried to touch a high today. But this is something to be concerned about.